The contract is the loan. So you've spent weeks and weeks looking for the right property, and you find the right property, and the next thing you know, in 90 seconds, you've signed an 11-page contract to purchase this home. That's where your loan's going to start, because before, you've been pre-approved. If you've got questions about how to get pre-approved, make sure to go back and look at my other videos. But you've now signed the contract. So what I want to cover with you today is actually what is in that contract. Now, let's get a couple of things straight. I'm not a real estate agent. I'm not a licensed real estate agent. I don't negotiate the contract. Also, I'm not an attorney, so I'm not giving you legal advice. What I want to break down is now that you've signed the contract, your loan is starting. So we're going to talk about the different phases through the contract that pertain to the loan. Let's get into it. First of all, I'm referencing a Tennessee real estate contract. So if you're in a different state, please keep in mind this could change according to your state. Each state has their own real estate contract, and then sometimes I've seen for sale by owner contracts that are one page long. But we're talking about a contract as written by the Tennessee Association of Realtors. So when you look at the contract, the very first page is going to set out the tone for the entire purchase agreement. It's going to have your purchase and sale. It's going to have your buyer's name, which that's kind of important that you know what to put on there. A lot of people, if you're out there and you go by your middle name, but all your legal documents include your first, make sure to include your first name on the contract. This is a legally binding agreement. And then obviously you're going to have your sellers and you're going to have the details of the property. Those things are pretty simple. But right in the first part of the contract, it's talking about items that are going to remain and items that are not going to remain. From a financing perspective, we find a lot of times that items to remain are considered personal. Let me give you a few examples. I've had contracts that says the lawnmower is to remain, or whatever other elements that are not tied to the real estate are to remain. And the contract says is to remain at no additional cost to the buyer, which means you've negotiated that potential thing into the sale of the real estate. Here's where it gets a little tricky though. The underwriter does not like that, because if you leave that on there as personal property, they're going to want the appraiser to separate the value of, let's just say, a said lawnmower and the real estate itself, because you've lumped it into one price. Here's the simple solution. You either state the lawnmower conveys at no value, or you just take it out of the contract and you have a separate agreement between you and the seller. So it's important, don't go list a bunch of laundry things. And if you've got a good real estate agent, they will advise you on that. You don't want to nitpick and list a lot of the things, because depending on what it is, you may find yourself in this situation. And the last thing you want an appraiser to do, and an appraiser typically will not do, is they're not going to separate and go try to find the value of a 1995 John Deere lawnmower. The next thing on the purchase price is going to be getting to the nuts and bolts of the purchase price itself and of the types of terms that you're going to be obtaining. So in this contract in section 2, it's the purchase price, the method of the payment, and the closing costs. So we're going to dive deep into this section. First thing is, anyone who is signing this contract should have had a pre-approval. If not, then you're going to throw things in the wind to hope that you can purchase the home. So first thing is the financing contingency, the loan to be obtained. This is where you're going to input, after you determine that purchase price, how much are you putting down? Are you doing 100%? Are you doing an FHA with 3.5%? Are you putting 50% down? So you're going to determine what you're going to put down, what percentage you're going to put down that's going to lead to your principal loan amount. And then after you determine that, you're also going to notify the seller of what type of loan that you're going to go with. It gives you a box, and those options are conventional, FHA, rural development / USDA, VA, and then there's a box for other. What would go in the box for other? Sometimes agents like to put THDA if we're doing a THDA loan. This would also be if you're using what's considered a non-QM, such as a bank statement loan, or you're doing a DSCR, which is a debt service coverage ratio loan. It may be an asset depletion loan. So this would be what you would put in the other box. But this is very important when you're negotiating the contract, and this could be an indicator of if there's a multiple offer situation on what the seller accepts. Unfortunately, I've heard in experience that a lot of times real estate agents they will put a conventional option. However, the client was never approved for a conventional option. They were approved for an FHA option. Generally, the rule of thumb is most sellers are going to want to take a conventional over an FHA. There's all kinds of rules around the minimum property requirements in regards to appraisals. We can get into that in another video. But a lot of times if you're comparing conventional and FHA, the sellers are generally advised to take the conventional because of less concerns in regards to the property. So if you have an agent that intentionally, or a lender that intentionally has you to mislead the seller to mark a conventional knowing that they're going to flip it to an FHA, you need to evaluate the team that you're surrounding yourself with. But it does happen in a competitive market just to win the deal. Because what would happen after the fact, you'd have to notify the seller that you're switching your loan terms after you're bound. They're going to feel like there's not another option and probably continue. So make sure your agent, your lender are all on the same page. You're not doing anything tricky in regards to win a deal in that manner. So then we get to the loan obligations. The loan obligation is what the buyer is agreeing, or what the buyer certifies that they are going to do in regards to this contract to make sure they get to the closing table. There are 6 things that they are doing. Number 1, within 3 days of the binding contract, the buyer is going to make any and all applications. You really should have already done this. But to make any and all applications to pay for the credit report, and you're notifying the seller that you have applied to move forward. You're going to provide the lender's name and the contact information and any other information in regards to the first steps, making sure the credit report's paid for if your lender requires that. But you have to do this to let them know in good faith you are continuing to move forward with a transaction. The second thing is, as the transaction has taken place and as you've started that, within 14 days of the agreement, then you shall warrant to the seller by notifying them, typically it's written notice from your agent, from your buyer's agent, of the following: that you have obtained your insurance, you have your insurance lined up and ready to go, and that will be in effect. Here's why it's important to get your insurance quote up front. Just recently, most of my estimates for insurance are around an $1,800 premium, depending on the property. I did that. The client received a quote that was double that amount. The insurance premium could be an impact to your debt to income. So that's why you need to find that out sooner than later in regards to how much your insurance premium is going to be. If you're sitting on top margins, it could impact your debt to income, which impacts your qualification. The next thing is the buyer has notified the lender of the intent to proceed and has the available funds per the signed loan estimate. So when you're initially disclosed after we receive the contract, there's a period of time within 3 days we have to send disclosures. On those disclosures, we'll tell you the estimated cash to close for that amount. With that, we have to, as the lender, know where those funds are coming from. If it's $1,000, if it's $100,000, we have to know where those funds are coming from. If it's a gift, then we're going to need the gift donor's information. We're going to need the documentation to know that they're going to send that to the title company. If it is in your bank statements, we need your updated bank statements. So you are telling the seller that you have provided the lender the path and the verification to make sure that you show up to the closing table with the amount of money that was provided on the loan estimate. And the other thing is the lender that you have instructed the lender to order the appraisal. So right now, a lot of times the inspection can hinder the lender from ordering the appraisal. But as a lender, we have to set a timeline on the contract from when this is received that this has to be ordered. Now, do keep in mind, these dates are going by the binding agreement date, which is going to be bound by both real estate agents and all clients. So if you've held the contract or the agent has held the contract before providing it to a lender for 5 days, the lender's already lost time in regards to what they're going to be working with. So from that aspect, it's very important the lender receives your contract the next day after it is bound and it's agreed upon. So the appraisal has to be ordered within that 14-day period to make sure things stay on track. If you wait the 14th day, you've already waited on a 30-day contract about half the time, and that's going to really put pressure to get to the closing table. What's the next thing? The next thing is that the buyer shall pursue the qualification for approval of the loan diligently and in good faith. That means that you are working with your lender on any documents requested, anything needing. You're not delaying the process. You're not responding. You're not sitting back on pay stubs, and you're not answering questions. You should be interactive with your lender at all times, communicating with them. If they need letters of explanation, getting that back, getting it through the process. You, in good faith, are doing everything you can to secure the loan. The buyer shall continually and immediately provide requested documentations to the lender or the loan originator. I wish we could forcefully have that in place, because a lot of times clients will just slow walk things. If we ask for a document, the expectation is to have the document back within 24 hours so we can be prepared to be at the closing table, to meet at the closing table. Unfortunately, we get the common verbiage, "Oh yes, I'll get that to you." But then it takes another follow-up email, another follow-up text, another follow-up phone call. 4 or 5 days goes by and it's not there. So it's very important that you're immediately providing the requested documents to not hinder or to cause an extension on the purchase contract. Number 5, it says, unless otherwise stated in the agreement, the buyer represents that this loan is not contingent upon the lease or sale of any property, and the same shall not be used for the basis of denial of a loan denial. Here's what this means. If you have a home to sell, if you have a home that you're going to lease to offset your current mortgage payment so you can qualify, you have to let it be known within the contract. There's a special stipulations part we'll discuss in a moment. You have to let it be known in the contract. True story, I had a scenario where the loan was contingent upon the home selling. There's no way the loan would have happened unless it was sold. I was working with the client. I made that clear to them. In the midst of that, I was trying to find out the net numbers from the property he was selling so we could do a proper game plan, because the net numbers was requiring that he paid off debt to qualify for the loan. Unfortunately, we did not have a very good partner on the sell side or the buy side as far as a real estate agent, because they were not providing the information that we needed. However, they took the client to go under contract on a home, and they used my pre-approval that was subject to the home selling. Everyone was notified within that, with the exception of the seller, because when I reviewed the contract, I noticed the special stipulations did not say subject to the home sale. I called the seller's agent. I notified them. I said, were you made aware that they have to sell their home? And they said, no, we were not. And at that point, the agent could have went back and terminated that contract. She said, I thought it was interesting that they kept pushing the closing date out. We wanted to close in 30 days. They wanted to close in 45 or 60. But they never notified the seller's agent that there was a home to sell. If we would have declined them because their home did not sell, because the contract was not written correctly, that would have not been a basis of denial, which would allow them to receive their earnest money. So it's so important. In the transaction, honesty is always so important. Don't try to skate the system by doing it one way in the hopes, especially in a market like this, that a home will sell. You're putting your client at risk. Not only at risk at losing earnest money, you're putting your license at risk, knowingly doing that as a real estate agent. So if you're planning to lease the departing residence, if you're planning to sell the departing residence, and it's all part of the loan transaction, that has to be disclosed in the contract. And then number 6, the buyer shall not intentionally make any material changes in the buyer's condition which would adversely affect the buyer's ability to obtain a primary loan or a loan referenced herein. I've had the conversations before with clients that have said, I don't want to buy this house anymore. I need you to deny me. And I said, I have no reason to deny you. Your debt to income's fine. You have a job. You have money in the bank. Like, I have no reason to deny you because you have cold feet. And they say, what if I go buy a car? Well, that's what this relates to. What if I quit my job? Well, that's what this relates to. If you intentionally make material changes just to be denied for the loan, then this is going to violate the contract, which is going to put legal ramifications on you potentially should the seller choose to do that. So don't go just because you get cold feet. Work it out. Talk to them. You might have to surrender the earnest money. I don't know. But you cannot intentionally go sabotage your deal just because you want the loan denied. The other part of the contract, there's a financing contingency waived. Just very quickly, it is what it is. If you sign that box that you're waiving any type of financing contingency, guess what? That earnest money doesn't matter. I saw one that was a very strong offer, and back in the days of COVID, we would actually see this because the lenders would tell someone that they were pre-approved, and therefore they would take that pre-approval to know that it is solidified, even though there's elements through the process that could make that change. When you select financing is waived, there's no umbrella of protection based on the loan being financed. So it's very risky to do that. Really, if you're doing that, you're presenting an all-cash offer. So you need to have a way to prove whether it's a large line of credit that you're using, whether it's investment funds that you're using. But if you sign that to obtain the contract and you know you're going to get a financing, you put yourself at a high risk. Hey, do me a favor. If you like this video, make sure to leave me a comment, like, and hit that subscribe button. Also, if you know of someone that's maybe looking to purchase a home or even a refinance, hit the share so they can get all this information for themselves.